Okay. So this chapter is all about depreciation. There are a couple things that I told y'all last time were cut with depletion and listed property, which is to do with cars. Just don't have time. We're discussing the big topic. So, how many of you guys are planning on sitting for the CPA exam eventually? Right? Okay, so the majority of the class. Yes, okay. So the way the depreciation is taught in this book uses a shortened method. We use these little charts, which I'll hand them out to you guys. And it's fine. There's nothing wrong with that. In fact, in the real world, that is how you will calculate depreciation. You will either put it into little programs and they will spit out all the depreciation for you, or you will use these charts, which are published by the IRS. However, if you're planning on sitting for the CPA exam, they expect you to be able to calculate depreciation longhand. So I will show you guys how to calculate it longhand as we go along. Just know that for this class, you are not tested on doing it longhand. I'm just showing it to you as an FYI, so that when you sit for the exam, this real CPA exam, which is really why most of us are here, then you know, you will not be all new to you, okay? All right. These are big picture facts. We're back here with Dr. Payne, the dentist, and these are the assets that he bought and put into service during the year. He has some furniture and some fixtures, some computer equipment, and some dental equipment. And he also bought another house for $300,000. So he decided to convert his original house to a rental property. So there's that. He also bought a condo for $170,000 near his office that he is going to rent. So those are our big picture facts. So cost recovery, which is what this chapter is about, can either be in the form of depreciation, amortization, or depletion. All this means is you get to recover your cost as a deduction over time. If you will remember last time, we talked about the difference between expense versus capitalized. So if you get to expense something, that means you get to take an immediate deduction. If you capitalize, you have to wait and take your deductions over time through some sort of cost recovery mechanism. Either depreciation, amortization, or depletion. Depletion is used for minerals, natural resources. Amortization is used for intangibles. And depreciation is used for tangibles. All forms of cost recovery, but depending upon what type of asset you're looking at, we call it something different. And it's a different code section. We are going to spend the majority of this chapter, the vast, vast majority, talking about depreciation. We will spend maybe 5 minutes talking about amortization, just because honestly there's not a whole lot to say about amortization. It's pretty simple. Not a lot of conversations to have about amortization. And depletion, we are skipping. We don't have time to cover it. So, let's go on to look at slide 5. So, depreciation involves 2 types of properties: personal property and real property. When we say personal property, we do not mean personal use property. Okay, we mean a piece of property that is not real property. So not a building or something associated with the land. I do not mean personal use property. In fact, to be able to take depreciation at all, the property has to be either used in a trade or business, T or B, or an income producing property. So this is to take depreciation at all. It has to be subject to wear and tear. The book doesn't say this, but obviously it has to be something not subject to an immediate deduction. So if you remember in the last chapter, we talked about some things like, for example, repairing a roof. Repairing a roof is something that you would get an immediate deduction for. But if you're building a new roof, then you have to depreciate the roof over time. Okay? So, something that you're not getting some sort of immediate deduction or expense for. Another example I gave of things that you get an immediate expense for are like something that's recurring, some little part that you have to buy often, something like that. If you know it'll be used within 12 months, then that's something you get an immediate expense for and you do not go through depreciation. But if you are buying some piece of equipment, maybe a computer, maybe a printer, maybe a little backhoe or something like that, something that you're going to get more use out of the first year, it's going to have use beyond that, then that's going to be something that's subject to depreciation. Let's talk about some general considerations that you need to think about before we actually get into the mechanics of a calculation. The first thing you need to know is that when we take depreciation, or amortization for that matter, okay, we reduce the basis. So let's say we pay $1 million for a building. So $1 million is your basis, correct? That's what you paid for it, $1 million. Depreciation is taken off of the basis. Then let's just assume, okay, I'm not calculating it right now. Let's just assume in the first year we take $5,000 of depreciation. Now we have a basis of $995,000. This is our new basis. So what we are doing when we take these depreciation deductions, first of all, you get an immediate deduction of $5,000, right? This is an above-the-line deduction, a business expense. If it's related to a rental property, it would be on Schedule E, right? If it's just regular trade or business, it'll be an above-the-line deduction, a business expense. And this is an actual deduction to offset ordinary income. Now what happens when the property is sold down the road? We have a decreased basis, so there will be more gain. So what we're effectively doing, yes, the IRS or the Congress allows you to take a depreciation deduction, but later when you sell the property, you have to recognize more gain. Okay? In fact, there is a code section, which is not discussed in this chapter. We won't actually get to it in this class. But there is a code section that says, to the extent you have gain, and it is related to depreciation you have already taken, that piece is taxed at ordinary income rates. So just know that when we decrease our basis, what we're effectively doing is creating more gain later when the property is sold. There is this concept in the book, I've really never heard of it before I taught this class, of, let's see, allowed versus allowable depreciation. So the allowed cost recovery is the amount actually taken. The allowable is the amount that could have been taken. So if for some reason you have a taxpayer, let's talk about this taxpayer, and they decide they don't want to take $5,000 of depreciation, they only want to take $3,000. The code says that we still have to reduce their basis down to the amount that they could have taken, which is $995,000. Like I said, I've never seen this concept before I taught this class. I think that's because in practice, this never comes up. People always take the depreciation that's given to them. This is one of those academic conversations, I guess. Because in reality, people take the depreciation that's given to them. And this doesn't really come up. But just know, in the code, there is a difference between what is allowed and allowable. Allowed is what you actually take. Allowable is what you could have taken. And the code requires you to adjust your basis as if you took all that you could have taken. Okay? Another general consideration. What if you have a piece of property and it is a personal use asset? So let's say you have a car and it is your personal car, and then you decide, hey, you know what, I'm going to start a business delivering flowers. So during the year, you convert this personal use property to a business property, or at least a partial business property. If you convert a personal property, now remember, personal use properties are not subject to depreciation. You don't get depreciation on personal use property. But once you convert it to a business use, now we get to take depreciation. The question is, what's our basis? Because depreciation is taken off of your basis. Is the basis what you paid for it? Or is it the fair market value when it's converted to business purposes? It usually matters. For something like a car, you usually pay a lot more for it than it's worth a couple years later. Or another common example is laptops. You have a personal use computer that gets converted into business use. We all know you pay $1,000 for a laptop, and then 6 months later it's worth like $200. So the code says our basis for cost recovery is the lower of your cost basis, so what you paid for it, or the fair market value at the date of conversion. And if you have some sort of loss that occurred prior to conversion, you can't take the loss. Why? Because it's a personal use property. Yes?
So, like, if you're an Uber driver, can you take a depreciation on your car?
Yeah, there are special rules for that kind of thing, and I don't remember what they are. I think you can, but first of all, there are special rules for cars, period. And we don't have time to cover that. That's in the listed property section. And then aside from that, there are like exceptions to exceptions for Uber cars. Not just Uber, but Uber and similar brands. And I can't remember what they are. I'd have to look it up. I don't remember, I'm sorry. Okay. Now, like I said, if you have a personal use property that's converted to business use, and you have some sort of loss at conversion, you don't get to use that loss. Why? Because it's a loss that was created when it was a personal use property. And can you deduct personal losses? No. Very few exceptions. No, you can't deduct personal losses. So I'm going to go back to this. So let's look at our big picture facts. Dr. Payne bought a personal residence for $250,000. Then he decided, I don't really want to live here anymore. I'm going to buy something new. So he buys a new house and says, I can't really sell my old house because I'm going to lose so much money on it. It's declined in value. So I think I'm going to rent it out to people. So he has a conversion from a personal use property to a business use, specifically an income-producing property. So is he going to get to take depreciation on it once it's converted? Yes. What's his basis? He originally paid $250,000 for it. At conversion, it was appraised for $180,000. What's going to be his basis for cost recovery? $180,000, right? The lower of fair market value or basis. Now he had a $70,000 loss, right? He paid $250,000. It had a fair market value of $180,000 at conversion. So this is a $70,000 loss. Does he get to take that loss? No, it's disallowed because it's related to his personal use. One other thing I want you to know is, it's not discussed in the slides, but something we need to know ahead of time. If you buy a property subject to depreciation and you sell it in the same year, you don't get any depreciation. Okay? If you buy and sell in the same year, no depreciation. There's a question on your exam similar to ask that. It's important to know. If you buy and sell in the same year, you don't get anything. So we're going to spend the majority of our time talking about personal and real property. Like I said, we'll spend maybe 5 or 10 minutes on amortization, but most of our time on depreciation is going to be spent on personal property and real property. Now, I know you guys have probably heard of this concept of salvage value, right? Maybe from financial accounting. There's no concept of salvage value in depreciation for tax. So often I've seen this on CPA questions, I've seen it on questions for this book. They will tell you what the salvage value is, or the salvage life, or whatever they call it, just to throw you off. We don't need that when we're calculating depreciation for tax purposes. So, what we use when we calculate depreciation is called MACRS. Modified Accelerated Cost Recovery System. You do not need to know what it stands for. Just know that it's called MACRS. And this is what the system that we use to calculate depreciation. This is not the system that we use to calculate amortization. This is just depreciation. With MACRS, there are 3 things, or I don't know the right word, categories, I guess, inputs that you need to know to calculate a MACRS depreciation. The first one is your class life. I also call it the recovery period. I think it's called recovery period in the code, but you may see it either way. There's the method, and there's the convention. So if you're talking about personal property, okay, if you look up here on slide 10, personal property can either have a class life of 3, 5, 7, 10, 15, or 20 years. if you're looking at a property that has a class life of the 3, 5, 7, or 10 years, it has a 200% declining balance method. And I know you don't have any idea what that means. Talk about it in just a second. And 150% declining balance method is used for 15 or 20-year property. And for any personal property, it can have either the half year or the mid-quarter convention. So how do you know, the first question, how do you know what class life to use? Well, if you look in the book on page A5, Exhibit A1, this chart gives you just a small excerpt. There are these revenue procedures out there that the IRS writes, and they basically tell you if you have this kind of property, it has a class life of X. And these lists are massive, and they're changing all the time because people have new kinds of assets that come into play all the time. And this is not something that you need to know, okay? Really the problems that are going to be on the exam, they tell you what the class life is. The problems I've seen on the CPA exam, they tell you what it is. They do not expect you to memorize this. I mean, the list is, 20, 30 pages long. But this excerpt here will give you an idea. On page 8.5, a 3-year property, so it has a 3-year class life. A tractor unit, special tools and manufacturing of motor vehicles, a racehorse that is more than 2 years old, a 5-year property, automobiles and taxis, calculators and copiers, computers and equipment, rental appliances, furniture, carpets. A 7-year property is office furniture, fixtures, equipment. 10-year is vessels, barges, tugs, and similar water transportation equipment. You can see how the descriptions are very specific, okay? So if you ever have a question in practice, you have to go to these revenue procedures and find, sometimes there's not something that's exact. You have to find something that is the closest that you can find, okay? But they are very specific. The descriptions of the property are specific. I want to talk for a minute about the 15 or 20-year property. I haven't seen any of these in practice. Of course, they're there. They're just not very common. And you can look in the book, 15 or 20-year. A 15-year property is assets used in the manufacture of cement, assets used for industrial steam and electric generation. 20-year is farm buildings and water utilities. These are just examples. This is just a small excerpt out of the book. Really, the point is to show you that they are very detailed in their descriptions of these assets. And if you ever see it in practice, you need to go to the revenue procedures and you need to find a description of whatever asset you are looking at and figure out what class life it is. In this class, on the exam, on the CPA exam, they will tell you what class life it is. So it's not the kind of thing, in real life, you just look it up. Okay, is what I'm telling you. For the most part, you see 3, 5, and 7 years. That's what I see. 3, 5, and 7 years. So I've written this up here. I want you guys to think about when you are approaching a depreciation problem, the things that you need to be able to identify. With personal property, you need to figure out what is the recovery period. That's kind of the first question. What's the recovery period? Is it 3, 5, 7, 10, 15, or 20 years? Those are your options. Like that was just on slide 10. What's the recovery period? The second question that you need to figure out is what is the convention? With personal property, it is either mid-quarter or it is half year. Those are your options. The third thing, which I'm going to maybe put a little star, because you only need to know the third one if you are calculating it by hand. If you are using the charts in the book, which is what we're doing in this class, you do not need to know the third one. Only if you're calculating it by hand, I'll put by hand, manually, okay, you need to know the method. Which is either the 200% declining balance or the 150% declining balance method. Now I know we're not talking about real property at this second, but I want, since we're laying it out, let's go ahead and talk about real property right now. Real property, when we say real property, we're really talking about the buildings, because you cannot depreciate land. Land is not depreciable for tax purposes. The buildings are, the improvements are, things like that. That's going to be real property. And I know the line can get fuzzy between what's real property and what's personal property. It can get fuzzy, I can tell you. Like, for example, if you put a new roof on a house, is that real property or is that personal property? I don't know. I'd have to do research to figure it out. Just the line is sometimes fuzzy. And in your class, you'll know. Okay, they'll say this is a building. Okay, well that's real property. With real property, you need to know less. Real property is simpler. You need to know, is it residential rental property or non-residential property? And you need to know the month it is placed in service. Because real property always uses the mid-month method. One other thing you need to know I forgot to mention. If you are using the mid-quarter method, you need to know the quarter it is placed into service. Notice I use the phrase placed into service and not the phrase purchased. That's because for depreciation, we don't, and amortization for that matter too, we don't actually care when you bought it. We care when you started using it in your business. So if you buy a piece of property at the end of 2016, but you don't, like a piece of equipment, but you don't start using it until 2017, you can't start taking depreciation until 2017. We care about when it's placed into service. We don't care when you bought it. We care when it's placed into service. And the phrasing placed into service is what is used in the code. So that is what I say. All that means is, when is it started? When do they initially start to use it in the business? So let's talk about the half-year convention first. So we're going to talk about personal property first, and we're going to talk about the half-year convention first, and then we will talk about the mid-quarter convention. We have already talked about recovery period. Remember, I went through the list in the book, and I said there are these huge revenue procedures out there, and they detail what recovery period or what class like to use. So, let's talk about the half-year convention. Again, we only use half-year or mid-quarter if we are talking about personal property. Real property always uses the mid-month convention. So, half-year or mid-quarter. Half-year is used, this is kind of the general. You use the half-year convention. With the half-year convention, we treat property as being placed into service in the middle of the year irregardless of when it was actually placed into service. So if you have a piece of property and you purchase it in April, you get your first year of depreciation is going to be cut in half. And your last year of depreciation is cut in half. That's all that means when we say half-year convention. It means your first year that it's put into service, you get half the depreciation. Your last year that it's put into service, you get half the depreciation. Your last year can be one of two things. It can be either the last year of recovery. So if you have a 5-year property, the last year of recovery is actually going to be year 6, because you get half of your depreciation in year 1 and you'll get half of it in year 6. I know it's a little confusing because it's a 5-year property, but you actually get 6 years of depreciation because the first and the 6th year you only get half. So you're really only getting 5 years of depreciation, but the first one and the last one are split into 2 different years, right? But we still get 5 total. So your last year of depreciation is either going to be the last year of recovery or the year of sale. Unless you buy it and sell it in the same year, and then how much depreciation do you get? None, right? Okay. So, let's do an example. Let's look at an example in the book. This is example 3. Kareem acquires a 5-year property, so he's getting a 5-year property, and he's paying $30,000 for it, and it is placed into service in April 2016. So these are our facts. So if we're going to do this longhand, we have a $30,000 property. So this is our base. Okay, this is our basis. Divided by 5, because it has a recovery period of 5 years, times 2. Why? Because we are using the double declining balance method. We use the double declining, or not always say double, the declining balance method, which is 200%. 200% or 150%. So we multiply times 2. And then in the first year, because we are using the half-year convention, they're only going to get half a year of depreciation. So we're going to multiply times 1/2. So in the first year, they're going to get depreciation of $6,000. If you do it longhand. Now in the second year, you don't have to worry about this 1/2. It's gone. Okay? You only worry about the half-year convention in the first year of recovery. I think it's the last year of recovery. No, first year and the last year. So now let's talk about the method the book uses and the method you'll use in real life. Please keep these because you need to bring them in with you to the exam. There are about 8 problems on the exam where you have to use these charts. So if you don't bring in the charts and know how to use them, you'll probably fail the exam. the shortcut. So the important thing with these charts is first figuring out which chart to use. Because if you'll notice, there's like 6 or 7 of them. So let's look at Exhibit A3, the one at the top. It says in the title, Maker's Depreciation for Personal Property Assuming a Half-Year Convention. That's where we are. We're using Makers for personal property and using the half-year convention. So this is the chart we need to be in. Okay? The second question we have to know. What is our recovery period? Well, the problem says 5 years. So we can see here in this column, second one here, the third one really, it says 5 years. And in parentheses below it, it says 200% declining balance. With these charts, you don't have to know the method because it's already computed into the schedule. So this is a 5-year property, and we are looking at the first year of recovery. Look at the column here on the left that says recovery year. We are in the first year of recovery, or the first year of depreciation, which is 20. Okay? So we will multiply $30,000 times 0.2, which is $6,000 of depreciation in year 1. That's it. You take the little number that it tells you in the column and you multiply it times your basis. If you were looking at calculating it in the second year, you would take $30,000 times 0.32. Okay? The half-year convention is very simple. Honestly, with these charts, they're all pretty simple. But now, the second thing you really need to know for the exam is, well, what happens if you sell it in 2017? If you sell it in 2017. Well, that means year 2. So in year 2, we're taking $30,000 and we're multiplying it times what? 0.32, right? Which equals, just 1 second, before I multiply. But, because this is the last year of recovery, the year of sale, they are only going to get half of their depreciation. So times 1/2. Whatever the answer is your answer for this problem. Okay? So if they're selling it at any point in 2017, okay, then it might be. Yeah. They do it a little bit differently. But this would be your answers and someone can calculate it and give me the answer. But you just need to know you need to use the number for the second year of recovery. And because this is the half-year convention, they're only going to get half of that year's depreciation. Note, please note, you do have to add this in manually because the chart doesn't know that you're selling it this year. Okay? But in the first year that you buy it, it knows you're only getting half year of depreciation, and the chart has already taken that into consideration. But when you sell it, the chart has no idea that you're selling it. So you have to manually add in 1/2 because we are in the half-year convention. Does everyone understand that? See how that works? Okay. Now let's talk about the mid-quarter convention. The mid-quarter convention is not elective. It is mandatory. And it is mandatory if 40% of the value of your assets that are placed in service during the year are placed in service in the last quarter of the year. So what we're concerned about is if 40% of the value is placed in service in the last quarter of the year. And if they are, then you have to know what quarter each property is placed into service. So let's look at an example. This is example 5. Silver acquires the following 5-year property. So we have 3 different 5-year properties. We have the first property, which was purchased on February 15th, which they paid $200,000 for it. And then the second one was purchased on July 10th, and they paid $400,000 for it. And then the last one was placed into service on December 5th, and they paid $600,000 for it. So these are 3 different properties. Now, is 40% of the value of their properties placed into service during the year in the last quarter of the year? So they have $1.2 million, right, of value. What quarter is this in? First. What quarter is this one in? The third. What quarter is this in? Fourth. And this is 50% of the value. So that is greater than 40%. So that means for all of these assets, we have to use the mid-quarter convention. Not just for this one, for all of them. So we have to know what quarter all of them were placed into service in order to use the mid-quarter convention. So if we look at Exhibit 8.4, in the title it says, Maker's Depreciation for Personal Property Assuming a Mid-Quarter Convention. With the mid-quarter, it works very similar to the half-year, except instead of assuming we're putting it in place in the middle of the year, we're assuming it is put in place in the middle of the quarter. Okay? So we have the same rules for the first year and the last year for mid-quarter as we have for half-year. We only care about the mid-quarter, really, in the first year and the last year. So let's determine what our depreciation is going to be for these 3 assets. Okay? For the first asset, which we paid $200,000 for, let's take a look at our chart. Now, if you look at this chart, notice I missed this a couple times. So just pay attention to it. You might want to highlight it or something. We have 3-year properties right here, 5-year properties, and then 7-year properties. And that's only stated in the middle. Okay? So you need to know, first question, what's the recovery period? All these properties are 5-year properties. So we're going to be in the middle, 5-year properties. This is the first year of recovery. So we're going to be in year 1. Now, what quarter is this one placed into service? First quarter. So what percentage do we want to use here? 0.35. That's right. What percentage do we need to use for this one?
15 or 0.15.
0.15, exactly. What about this one? Does everyone see where John's getting these numbers? Yes.
Why is it 0.005?
Oh, you're right. Sorry. 0.05. Move the decimal point 2 places, not 3. 2. So that equals $70,000, $60,000, and $30,000. So total depreciation for the year is $160,000. Yes.
So if like some of them were different years, you would just use like the correlating value.
What do you mean
So if
different
like
years?
property 1 was 5-year, property 2 was 7-year, you just.
That's right. And we're going to do an example just like that in a second. That's right. So if property 2 was not a 5-year property, it was a 7-year property, you are going to be in the same chart, except instead of being under the 5-year, you'll be at the very bottom under 7-year. Works exactly the same. So the next question in example 6, in this example, we're assuming that this asset that was purchased on July 10th is being sold on November 30th, 2017. So we're going to sell it on 2017, November 30th, just this asset. So we want to know what's going to be the depreciation for this asset in year 2. We can only go up to year 2 because that's all that the charts in the book give us. Okay? So let's look at year 2. Remember, this is still a 5-year property. It was still put into place in the 3rd quarter, so we are still in the 5-year for the 3rd quarter column. But now we're in the 2nd year of recovery, right? So what's the percentage that we need to use here? 0.34, that's right. So we're at $400,000 times 0.34 times, since we're selling it, we have to manually determine how much depreciation they're actually going to get. Just like we did with the half-year convention, except now we're doing it with the mid-quarter convention. So how many quarters are in a year? 4. So our denominator is always 4. Now let's determine what the numerator is going to be with the mid-quarter convention. If they're selling it in November, they are getting how many quarters worth of full depreciation? Three. That's right, they're getting 3 full quarters. And how many are they going to get in the 4th? Half. Right? This is the mid-quarter convention. It doesn't matter that it was sold on November 30th. They get half of the last quarter. So that would be 3.5 over 4. That is how much depreciation they're going to get in the last quarter, which is $119,000 total depreciation. Now, okay, so what if instead of being sold November 30th, they sold it April 30th. Now how much depreciation are they, what's going to be on our numerator here? Everything else is going to be the same, right? What's the numerator here? That's right, 1.5, because we had 1 full quarter and half of the second one. That's what the mid-quarter convention is. Okay, you want to see that? You do have questions on your exam, or you have to manually put in, what if I'm selling it? How do I calculate? Let's do another example of the mid-quarter, and I'll show you how to do it manually. So let's look at our big picture facts. This is Dr. Payne's purchases during the year. He bought office furniture and fixtures, and he bought them on September 29th. He bought computer equipment on September 29th. And dental equipment on October 3rd. Now, so our question is 40% of the value being placed into service, does it happen in the last quarter of the year? September 29th, September 29th, October 3rd. Yes. October 3rd is in the 4th quarter. September 29th is in the 3rd quarter. Since this is $475,000, that's definitely going to be over 40% of the total value. If we look at 70, 67, and 475. So we know, okay, we're going to be using the mid-quarter convention here. This problem doesn't tell you, but I will tell you, Office furniture and fixtures are a 7-year property. Computers are 5 years, and dental equipment is 7 years. Again, that's not something you're going to be asked to identify. We'll just tell you told that. But if you had to look it up, you'd use those little charts. Okay? So we have 7, 5, and 7 years. So going and looking at Exhibit A4. Exhibit A4. We have the first one is a 7-year property. So we're at the very bottom, and it was placed into service in the 3rd quarter of the year. So we're using 0.1071 as our percentage. This is a 5-year property. So we are going to use, and it was also placed into service in the 3rd quarter of the year. So we use 0.15, which you can see right here on your chart. Dental equipment, which is a 7-year property, so now we're at the bottom again, but it's placed into service in the 4th quarter. So we're going to use 0.0357 as our percentage. So looking at the first property, if you were to calculate this manually, it works very similar to the half-year calculation that we did. You'll take $70,000 divided by 7, which this is our recovery period, this is our basis, times 2, because we are still using the double declining balance method, times, instead of times 1/2, we are going to figure out what quarter we're using, because we're using the mid-quarter convention. So we know our denominator is 4, because we have 4 quarters. So what's going to be our numerator? So if this property was placed into service in the 3rd quarter, how much depreciation are they going to get in the 1st year that they purchase? What is left during the year? How many full quarters? 1. And they also get half of the one that they're in, right? They're in the 3rd quarter when they purchased it, so they get half of the 3rd quarter and all of the 4th quarter, because that is what's left. We do it basically the opposite as if we were selling it, because when you sell it, you get what is already there before you sold it. When you buy it, you get whatever is left in the year. So we're going to have 1.5 over 4. Move on and talk about real estate. So like I said, there are 2 different categories for real property. We have residential rental property, which is like apartments, honestly. It has to be something that's not transient. So for example, a hotel is transient. That's not a rental property. If you have a rental house, obviously that's a rental property. Apartment complex, that's a rental property. 80% of the gross rental has to come from rental revenues, basically, to be a residential rental property. Again, if it's a hotel, that is not a rental property. And then the other category is non-residential. That just means, hey, it doesn't fall under residential rental. It's whatever else there is, non-residential. So notice there's nothing in here that just says residential. Why is that? Because it's a personal use property and you cannot depreciate a personal use property. There has to be some sort of business use. So if it is a residential rental property, our recovery period is always 27.5 years. You don't have to look it up. It's just 27.5 years. If it is non-residential, it is 39 years. Again, Now, the book does say it can either be, if you look up here on slide 16, 31.5 years or 39. That's because there were a couple years in the 90s where I believe it's like 1990 to 1993, where if you put a property in service during that time period, they use 31.5 years. Don't worry about it for this class. We're only using 39 years. We're not going to go back and worry about those 3 years in the 90s when it was a different number. The method is always straight line, so we don't have the declining balance or the 150% method. We don't have that. And the convention is always mid-month. So we always have to know what month the property is placed into service. And very much like the last, we worry about the month for the first year and the last year. Last year being the last year of recovery or the year sold. Just like the last two methods. So let's look at a problem here. This is example 8. Alec acquired a building on April 1st, 1999, and he paid $800,000 for it. It is classified as residential rental property. So, the question we want to look at is, all right, which chart do we want to use for this? If we look at Exhibit 8, it says Maker's straight line depreciation for real property. We have real property, it's always straight line, so we're good. Okay, straight line. So, now if you look at this chart, notice it says it has the numbers 1 through 12 up at the top. Like I said, you have to know what month the property is placed into service. Just like the mid-quarter convention, you have to know what quarter it's placed into service. So with this property, it was placed into service on April 1st, 1999, and we want to know our depreciation deduction for 2016. So we're looking for 2016. So if we look at this chart, what month, first of all, we're going to be at the top column, the middle column, or the last columns? The top. Why? Because we are a residential real property, which has a recovery period of 27.5 years. You have to determine, are we residential or non-residential? For non-residential, you're at the bottom. If you're residential, you're at the top. So with residential, now what month is it placed into service? April, or the 4th month. And what recovery period category on the left, I know it's hard to see, are we in? That's right, 2 through 18. Because real property uses straight line, they're able to bulk everything together. After the first year, they can kind of bulk it together. Okay, so it doesn't matter, it's the same amount every year. So here, we're in 2 through 18, so our number that we're going to use is 3.636. So we're going to be $800,000 times 0.03636, which equals $29,088. Now let's look at example 10. In example 10, Mark acquired a building on November 19th, 2016. So he bought a building on November 19th, 2016. And this building, he paid $1.2 million for it. It is non-residential property. So it's going to have a recovery period of 39 years. So where are we going to be? The first or the third one? The third one. What year was it what month was it placed into service? November. And we're looking at what recovery year? 1. Right. So the number we're going to use, 0.321, which is 1.2 million times 0.00321. Okay? Which equals 3852. Now the next part of the problem says if the building is sold on May 21st, 2017, what is the cost recovery reduction? So it's sold on May 21st, 2017. So what's going to be our depreciation deduction? 1.2 million times what percentage are we going to use? We look at this chart. Say that again?
Is it 0.0160?
No. Just right, 2.564. Because it was placed in service in the 11th month of the year in 2016. We are in the second year of recovery, so the number we are going to use is 0.02564. 0.02564. But we also have to manually calculate, I know I'm going left, manually calculate what months they actually do get to take depreciation. So the denominator is 12, right? Because there's 12 months out of the year, just like in the last one, there were 4 quarters in the year. What's going to be our numerator? So if they sell it on May 21st, how many full months of depreciation did they get? 4, right? January, February, March, April. And then they get half of the 5th one because it's a mid-month convention. So 4.5 out of 12, right? Now, if you were going to calculate this depreciation manually, okay, for the original purchase, we have 1.2 million. Again, you don't have to know how to do this on the exam. Over 39 years, because that is our recovery period, times, we have to worry about how many months of depreciation they get if you're doing it manually. Okay? So if it was purchased in November 2016, how many full months of depreciation are they going to be able to take? What's left? 1 plus half of November. So 1.5 over 12. If you were calculating it manually. So that's it for this and this. When we come back on Wednesday, we are going to talk about the straight line election, alternative depreciation, additional depreciation you get in the first year, and amortization. Please bring these charts back with you next time, okay?